hear
The
you.
broadcast is now starting. All attendees are in listen-only mode.
Hi, a warm good morning to you all. I'm Sri Kumar Vital, Marketing Officer from the Embassy of India in Berlin. On behalf of our embassy, I convey a warm welcome to all of you, including our distinguished speakers from Khaitan and Co. to today's webinar, which focuses on an important topic, India Budget 2021-22, and what are the key takeaways for German companies. Friends, the budget 2021-22 will be a memorable one. Being the first budget of the decade, the first digital budget, and one coming from an economic contraction, it has excellently articulated the 6 pillars of health and well-being, infrastructure, inclusive growth, R&D and innovation, minimum government, maximum governance, and human capital. The higher public spending, especially on infrastructure projects, can lead to higher growth and jobs creation and huge opportunities for investment. The budget has also reiterated the confidence of taxpayers in the government's focus on ease of doing business in the country. The proposals made in the budget would go a long way in making the tax systems transparent and efficient and in promoting investments. The focus of the budget announcements on customs has been on 2 important fronts, namely promoting domestic manufacturing and helping India get into the global value chain and increase its exports. Reducing the import duty on various raw materials would give impetus to Indian manufacturers and provide a fillip to Make in India. All in all, the Union budget was a remarkable one and is a never-before budget in these never-before times. Friends, let me just now say a few lines about our Make in India program, especially for those friends who are not familiar with it. To convert the intent on part of the German business community into actual investments in India, we from the Embassy of India Berlin had initiated a dedicated and strategic program in 2015 called the Make in India Mittelstand. The program is run on behalf of our embassy by EuroAsia Consulting as a knowledge partner, supported by a network of competent partners such as Rodel & Partner, Khaitan & Co. as a tax and legal partners, the Indo-German Chamber of Commerce as the partner chamber, the Deutsche Bank, KfW DEG, and the State Bank of India as financing partners, the Global Innovation and Technology Alliance of CII as a technology partner, and many state governments in India. The program partners offer expert services in the fields of investment consulting, tax and legal, financial services, and project financing for market entry expansion, feasibility studies, and so on. Invest India, which is the official government agency for investment promotion, as well as 9 Indian state governments, are program partners who assist with regulations and permission issues to facilitate investment. Currently, the program organizes at least 2 webinars in a month on topics relevant to German Mittelstand companies. Friends, the MIIM program has entered its 6th year in September last year, achieving 150 onboarded Mittelstand member companies and facilitating a declared investment volume of about euro 1.4 billion. We from the embassy urge German Mittelstand companies to take advantage of the services provided under this program for their planned investment or expansions in India. Thank you for your kind attention. And back to you, Khaitan.
Thank you, Mr. Vidal. Ladies and gentlemen, today we have 3 eminent speakers from Khaitan and Company. I'll just introduce them briefly before handing over the presentation to them. We have Prasenjit Chakravarti. He is a partner in M&A and Corporate Practice Group at Khaitan and Co. at New Delhi office. Prasenjit regularly advises domestic and international corporate clients on wide array of transactions, including M&A, mergers, management buyouts, and foreign investments. Prasenjit also regularly advises European clients and also an integral part of firm's German desk. Then we have Ms. Vinita Krishnan, who is Director in Indirect Tax Practice in Mumbai. She has over 14 years of reach and varied experience in advising clients on domestic and international tax matters. Prior joining to Khaitan, she worked with E&Y India. Her expertise covers a broad spectrum of tax matters, which includes domestics and cross-border tax advisory, international tax, globalization, structuring of inbound and outbound investments, transactional tax, taxation of EPC contracts, and M&A. We have third speaker is Mr. Sudipta Bhattacharjee. He is a lawyer with close to 16 years of experience, specializing in indirect tax advisory, including GST, customs, international trade laws, pre-GST indirect taxes, as well as state excise laws affecting alcoholic beverage industry. He has been recognized as highly regarded in indirect tax by World Tax, the comprehensive guide to world's leading tax firms for 2020, as well as in 2021 as an indirect tax leader by International Tax Review since 2017. So I would like to now hand it over to Mr. Prasenjit, who will take us through the economic situation, or who will provide us the economic overview of India.
Thank you, Khaitan, for the warm introduction, and thank you, Mr. Vittal, for laying out really a lot of what I was planning to say. So I think that's very helpful to lay out very accurately the broad contours of the budget of 2021. And thank you for having us to shed some of the key insights of this budget and what it really means for India. I think before we dive into it, Khaitan, as a we are a preeminent Indian law firm with a dedicated German desk, and that is why we have kind of tailored this particular webinar for a German audience, and we have seasoned lawyers who have extensively worked with a German clientele. Without much ado, I think let's dive into the presentation for the day. Khaitan, can we go to the first slide, please? Thank you. So I think really, the purpose of at least what I am looking to tackle here is to give a broad sense of the macroeconomic outlook pursuant to this particular budget. Budget, we all know, is really a series of announcements, but it determines kind of the mood, the shape of the economy with the slew of measures which the budget can announce. And the Indian government hasn't let the people down. First and foremost, take a pause and look at the Indian economy. Like most countries, COVID-19 led to a contraction of Indian economy. But because of its resilience, because of timely stimulus packages, it kind of bounced back pretty quickly and found itself back on its feet. And so far as on the vaccination front is concerned, India is very well poised to really administer the vaccine to bulk of its population. In fact, India is one of the few countries who really has taken a giant stride forward and is exporting its vaccine to other countries. And as we speak, 25 countries are in queue to get the vaccination from India. And it's also very well placed to administer it to its own population who have, kind of suffered from COVID, or just to prevent the spread of the virus. So more or less, I think it's under control and looks good and promising from the COVID recovery standpoint. Let's go to the next slide, Khaitan. The first foremost thing we have to keep in mind that so far, because of the COVID, like most economies, India was in a survival mode. Now, what this budget does is make a statement that from survival mode, the government is looking to transform to a growth mode, put it back to in the growth trajectory. Now, how does it do that? Through a series of announcements. First and foremost, production-linked incentives have been granted to 13 sectors. These are key sectors including pharma, electronic, infrastructure. Now, what it does is it offers a lot of tax soaps, custom duties, reductions, some of which my colleagues will cover later on this presentation. The government also has prioritized key states like Tamil Nadu, West Bengal, Assam, which is crying for more development on infrastructure front, and that also is a very, very welcome step. Third factor, now this is a very critical step, is the liberalization in the insurance sector. With India's mass population, this sector was stagnating for quite a while because of it being cash strapped, with 49% FDI being increased to 74% FDI. This is just a right shot in the arm which this sector needs. What it will do is obviously allow foreign players to infuse capital, get majority shareholding, infuse technology to this sector, which means not only these Indian insurer companies will get more funds, it will bring into its ambit more customers and more people who can be insured. And with technology advancement, these Western countries can invest and really take the insurance sector to a completely new level, catapult to a new level altogether. Boost for infrastructure sector cannot be understated. The government has gone out of the way and earmarked unprecedented funds for development of the infrastructure sector, and this is one of the sectors which is really doing very, very well. Government has also not overlooked the MSME, the small scale sectors, often the growth, the engine which propels the growth of an economy. And MSME, bear in mind, was one of the worst hit sectors in the lockdown. So really by announcing a series of steps, including allocating funds for MSME, giving more tax rebates, the MSME sector is poised to bounce back and really flourish in years to come. Digital payment sector is one aspect which again has assumed a lot of significance. During lockdown, a lot of the transactions has been done online, and by allocating funds in this sector, this will actually consolidate and kind of bind together all areas of an economy in a very seamless fashion. The other two changes really are kind of legal. I think there's a lot of hue and cry about entrepreneurs being penalized for frivolous and trivial offenses. Now, what has happened is decriminalization has happened under the LLP Act. So offenses which are really not serious and grave in nature, those offenses are decriminalized and people will not be prosecuted for those and will only have to pay a minuscule fine. This will be a absolutely terrific leg up for entrepreneurs who can carry on the business without being hassled or too skeptical with these exorbitant penalties. We can move to the next slide, Khaitan. Now, this is more of how the economic and political outlook look like, some of which we've already covered, so I will not spend too much time. I think the government is a stable government. It came with a thumping majority. This allows precisely the government to take these bold steps without any hindrance from political quarters in India. It's very much mindful of tax rationalization from time to time, so that instead of tax terrorism, there is tax incentives which are being afforded to entrepreneurs. A majority of the sectors, as we just mentioned about insurance sector, is being constantly sought to be liberalized more and more to invite more foreign capital, which will augur well not only for foreign players but also really for the consumers in India. We can move to the next slide, Khaitan. Now, where the opportunity lies as German investors, if you're watching this, I would say 5 sectors which really stand out. First is infrastructure. As I mentioned, the government has earmarked a lot of funds for this sector and will go out of its way to facilitate in this sector any investment which comes in, whether it's roads, transport, renewables, you name it. Second is pharma sector. I think that has obviously done very well. As I said, the COVID vaccine, India is really one of the pioneers in that field and has done remarkably well. And government is very much, kind of mindful to take this sector to the next space so that affordable, healthcare can be afforded. Now, this is the third point: is healthcare. With such a vast population, government has put a lot of emphasis on healthcare as well, and FDI in this sector will also be welcomed with open arms because of the government policies. Insurance we have talked about, so I will not stress upon it, but it's being liberalized. I think it's a huge opportunity for foreign people to invest in this sector, take majority shareholding, and really capitalize on the wide consumer base in India. I mean, there's so much of population in India who needs insurance, and I think through this particular change, this can be a game changer for this particular sector. Fintech, we have talked briefly. I think financial technology is a key aspect in today's day and age. If you are not up to the speed in fintech, you will struggle. You need to catch up with what's happening in advanced economy like Germany. And I think a lot of investment in this sector will mean India will catch up speed with some of the best practices in world economy. Khaitan, next slide. I think the last really point which I wish to stress upon is which states, as a German investor, if you're looking at, you should focus on. While all states are more or less in India conducive to doing business, 5 states do stand out because of their infrastructure, the which it affords, and the business-friendly regime the local government which provides for. Gujarat is one of them. It's of course the hometown of our Prime Minister, and has consistently done well on account of several factors. So is Maharashtra and Delhi. Both of them have a lot of industries which are coming up because of the conducive atmosphere. And 2 other states not to be ignored are Karnataka and Tamil Nadu, the southern part of India, that is equally extremely potent and hotbed for foreign investments across a range of sectors. So in a nutshell, I think if I were to sum up the macroeconomic outlook, India is well positioned and poised to take giant strides forward, not only to shed all the nightmares of contraction which it briefly encountered during the COVID period at its peak, but really to come back on the growth trajectory and really surge forward. And this budget has given a tremendous leg up for all the relevant stakeholders, be it foreign investors, Indian companies, MSMEs, as well as relevant people who are attached with the economy and economic activities. Over to you, Khaitan. Thank you.
Thanks, Prasenjit. Khaitan, could you please go to the next slide?
Sure.
So I would be touching upon the key income tax proposals, which are very relevant from as an investor from our perspective. And to start with, as nicely addressed in the beginning of the webinar and supplemented by Prasenjit, Budget 2021 government really had a very tough task. On one hand, they had to address the shortfall in revenues, and on the other hand, they had to really balance how to give impetus to the growth of India. So amidst this, there were fears that whether there will be any increase in tax, whether there will be any new cess introduced as COVID cess, and it is heartening to note that there is no rejigging tax rates. So as a German entity, our base rates remains the same, whether it is a dividend income or whether it is interest income, or if we have a business income, it remains the same. Similarly, for our Indian presence in terms of subsidiaries, the tax rates remains the same. And it is interesting to note, while it is not very linked with this budget, and as India is poised to make and show India as really a Make in India campaign, and as a measure, and even today, considering what's happening in China, we can see and proudly say that India is to encourage to have one of the lowest tax rates amongst any other countries. So if you wish to set up a manufacturing base in India, the tax rates for the corporates in India can be as low as 15%. So this again complements with the current changes announced on the indirect tax front. And now coming to certain more proposals which the budget looked at. It aimed to tighten certain new straps in an M&A space. To start with, in the intangible acquisitions, which we would see, it's very common in an Indian space where an Indian entity may be acquiring an intangible as part of business acquisition from a seller. And last year, the most talked deal was the Hindustan Liver deal with the GSK. And one of the main component in the deal was also an intangible component. And there have been talks that the intangible component, if it is in nature of goodwill, is it eligible to a tax break? And this has been a matter of debate in the Indian context, where the Honorable Supreme Court had held, yes, goodwill is entitled to depreciation or an amortization. Essentially, it means if you pay a price towards goodwill, you can claim a tax break over a period of years. Now, the budget aims to say that goodwill is no longer a depreciable asset and you would not be entitled to it. So does it affect any past acquisitions which an entity has made, say a subsidiary or an Indian presence has made? Perhaps yes, because from April 2020 onwards, they would not be entitled to claim depreciation. So it would tweak some of the models or the valuation parameters when one would have looked into the M&A deal space. Whether the goodwill is in nature of an acquired goodwill or whether it is self-generated, both have been treated at par. The second important change is it's more of a change to bring in and tax the loophole in the income tax provisions. Under the Income Tax Act, typically where an Indian business is sold in lock and stock and barrel for a lump sum cash consideration, it is called as slump sale. And the seller of business is required to pay a capital gains tax, and there is a specific manner in which such gains are computed. And one of the advantages of slump sale is you don't need to really cherry pick and compute tax for each of your assets, but it is a standard holistic method given in the Indian tax laws. So there were certain cute structures adopted whereby a taxpayer used to say, hey, I am doing a business transfer, but as a consideration, it's a barter. I'm contributing my business and shares in return. So therefore, technically, since it is not a monetary consideration, it is not a sale and it is a slump exchange. And therefore, it should not be taxed in the Indian tax law. Unfortunately, there were certain judicial precedents also upholding and supporting such view. And currently, the budget proposes that whether it is slump sale or exchange, it would be brought under the tax net. The third change, which is again from tightening of an M&A space, is an exit or distribution from a limited partnerships. India has popularly known to have company structures which are very popular, whereas limited liability partnership is a recent phenomenon. And also from a foreign investor, while they are permitted to invest in LLPs, it is subject to certain conditions, do's and don'ts. But the main charm of LLP over a corporate entity was it distributes profits to the partners, there is no tax in the hands of LLP, and neither there is any tax in the hands of partner. Whereas any dividend received from a corporate entity is taxed in the hands of the shareholder under the current laws. This position remains unchanged even in the budget. But if the LLP is distributing any asset, or even a partner is cashing out and taking out more than his capital from the LLPs, there will be tax on the LLP. So one would need to really look at it. And now, while there were already certain provisions whereby any exit from the LLP, there was certain tax on the LLP, but there were certain judicial precedents which said if a partner is cashing out his cash, which he is entitled, and he is really revaluing his capital, there should be no tax. So again, those precedents have been upturned by the recent budget proposal. The fourth important change is in the digital space. As you would notice that in the pandemic world, how important the digital world has bring us close. So one of the change which India had brought in last year was introduction of a tax called as equalization levy. This tax neither wore the hat of income tax nor the indirect tax. So it created huge debate whether what is the nature of this tax. What essentially it targeted is if there is an online if there is a non-resident person, even if he's sitting in US or Germany, and they are supplying service or they are supplying goods over a digital platform to someone in India like Vinita, or someone who is using an Indian IP sitting in India, or even to a non-resident only in certain circumstances, then still they had to pay a tax called as equalization levy 2%. So there have been huge debate surrounding this tax. Now, whether since say German entity is not into e-commerce operator, so I don't need to worry. The God lies in detail. So even though you may not be technically an e-commerce operator, you would need to look at it whether it has any impact on us. Say, for example, the German parent has an online cloud storage and the Indian subsidiary uses it. Now, whether the Indian subsidiary and the transaction is coming to the Indian subsidiary over a platform usage, then perhaps you may need to consider the impact. Of course, there are certain safe harbor as well applicable in terms of this transaction. And what the budget did, the budget proposed to really define what is online sale and what is online supply. So even an act of taking payment online, or even if you accept an order online, may be treated as an online sale or supply. So one would really need to look at it the way the business models have been done to see whether there is any impact. And also budget has rightly carved out an exception that if a transaction is already subject to tax at a higher rate like a royalty or a FTS as a fees at 10%, then those should not be subject to equalization levy. Why this tax is important? Because this tax rate does not get lowered under any tax treaty. And also whether in your home jurisdiction, whether you would get credit of this tax is a matter of debate currently. The next change is mainly for an infrastructure space, and it's mainly for sovereign wealth funds and pension funds. With a view to attract them in India, there were certain measures announced even in the last budget. And there have been more exemption announced to them in terms of the rigors where they can invest in infrastructure sectors have been relaxed. They're also allowed to invest in InvITs. They're allowed to invest in AIFs with certain conditions. So what this exemption means, if there is a sovereign wealth fund or a pension fund which intends to invest in India, their capital gains, if it is in long-term in nature, their interest income or dividend income can be exempt from tax in India. Of course, which is a sovereign wealth fund and what is a pension fund, there are conditions maintained. And essentially, it should be backed up by governments. It should not be having any commercial motive, and they should get themselves notified that, yes, they are eligible for such exemptions. The next important change is a withholding tax. Even in a domestic sector today, while India has a comprehensive withholding tax provision, where a German entity is making payment to another non-resident, if whether it was purchasing a share, it had to be cautious that it had to deduct TDS in India. And even if it was with respect to residents, technically there are certain provisions, like if you are making payment to in nature of fees, in nature of rent, there were certain withholding tax requirements for the German parent in India. Practically many times, if they are making payments to residents, we have seen withholding tax provisions not being made applicable. Now the budget has introduced that it is a very residual section. Any purchase of goods from an Indian resident, where the Indian resident is selling a goods, and if the goods consideration is more than 5 million Indian rupees, and the purchaser of the goods has a turnover of more than 100 million in the previous tax year, then the purchaser is required to deduct TDS at the rate of 0.1% on those acquisition. Now, technically today, if a German entity is going to import goods from India, is it required to withhold tax? Based on the literal reading, the answer perhaps seems yes, but one is hopeful that they may bring out certain clarification, because this law is going to be made applicable only from July 1, 2021. The next thing is goods is not defined. So whether today, if you are going to buy shares from a resident in India, which otherwise was not attracting any withholding tax, would you be need to require to withhold tax? One would need to look at it closely, because goods can include shares. So again, we are expecting maybe they may relax for a purchaser who has no Indian presence to really not subject to such cumbersome withholding tax process. From a dispute resolution point of view, as also it was mentioned at the start and during the course of the webinar, that India is taking a lot of steps to make India as a transparent destination. In that spirit in mind, there are a lot of schemes which were announced, like a dispute which is called as Vivad Se Vishwas. What it aims, a taxpayer can go to the tax authorities and settle their case up to certain conditions and seek waiver of interest and penalty. So this is a very welcome move which was announced last year. And there is also a forum called as Authority of Advance Ruling. This forum was specially designed to mainly bring certainty for tax position for non-residents. And non-residents could knock the door of the Authority of Advance Ruling instead of going to the hierarchy route of going at a lower level of a tax officer, then an appellate level, then a court and a Supreme Court. They could have directly go to an Authority of Advance Ruling, which is a quasi-judicial custody. Now, what the beauty of this forum was, they could bring certainty and pass orders on the tax position of the foreign investor within a period of 6 months from the date of application. While that was the intent and that was the real intent of the forum, unfortunately, there have been a lot of backlog of cases, and because of which there have been a huge delay in the disposal of cases. And now the government proposes that this forum would be discontinued, while the forum in new avatar, it would have certain board in its freedom, and where the board will decide what would do to dissolve the cases. So this one has to wait and watch to see whether the AR would really will be effective going forward. The next change is from the statutory limits. Currently, the time limit to reopen cases can be as far as 7 years. In certain cases, it can be 10 or 16. The budget proposes that it can be reduced to 3 years and 10 years. And one would need to again keep a close watch, because in many share purchase deals, especially where even if a German entity was purchasing shares from a non-resident, it is very typical to have certain indemnity from the non-resident sellers. Now, whether the indemnity period classically has been a period of 7 years, and the logic behind was because the seller could itself been chased for 7 years. So let's agree for a period of 7 years. So now whether 7 should become 10 years would also become a matter of interpretation. And the way the wordings of this provision are worded, it leads to a lot of ambiguity. So one is hopeful that again from an M&A space, one has to keep in mind what should be the indemnity period, especially if you're closing a deal next year. We should keep in mind the provision and rigors of this section. The last important change is, in order to make India as a smart city, there is a concept which was introduced as a smart city concept, IFFC, or International Financial Services Sector. This aims to really boost the financial sector of the Indian economy. And this is a special city introduced in the state of Gujarat. And not only there are tax exemptions, there are also a lot of legal exemptions which are announced in the state. What it aims, there were certain investors in that space, there were capital gains tax exemption, and also if there was an entrepreneur unit in those space, there are certain tax holiday. Now, the budget expands to give those exemptions, and also it encourages aircraft leasing companies to come to India, and whereby if a non-resident is going to have a royalty income from the aircraft leasing, it can become tax exempt subject to certain conditions. So overall, the budget did meet the expectations. Where it fell short, amongst the pandemic situation, there are a lot of cases where the Indians are stranded in India, even though they may be on the board of foreign entities, or there may be foreign expats who are stuck in any other country. Now, this issue is not burning issue, just not in India, but also globally. And there have been certain relaxations announced globally that when they are forced to stay in India, their involuntary presence should be excluded while computing any permanent establishment or computing any taxable presence for the individual's own case. But currently, there is sadly no relaxation announced. And recently, the Supreme Court also gave a direction that the Indian administrative body, that is called as a CBDT, a Central Board of Apex body, is required, and they should come up with a clarification soon. And one is hopeful that they will bring out that an involuntary stay should really not be counted while computing the digital space. And so, that's how I would like to sum up the income tax proposals. And now I would request Sudipta to walk through over the indirect tax proposals. Thank you, Khaitan.
Thank you, and a very good afternoon to all of you. Khaitan, if you can have the next slide. Yeah. So the indirect tax proposals in the budget can be discussed in three buckets: customs, GST, of course, and central sales tax, which is a pre-GST tax, which still governs some of the goods that are outside GST, like your petroleum products, alcoholic liquor for human consumption. We will start with customs. Next slide, please, Kim. Starting with the procedural changes, there has been an announcement of launching of a common customs electronic portal. While not much information is forthcoming about it, the idea is to create a single window approach. While there is a fair bit of digitization on the customs procedural front, I think after having the learnings from GST network and some of the other digitization projects, this is hopefully a more premium, a more user-friendly version that the government is trying to aim for. Second procedural change is about a new mandate about filing advance bill of entry. So if consignments are being sent to India, the day the consignment is supposed to reach, there is a mandate now to file the bill of entry for that consignment 1 day prior. This was happening on a more ad hoc basis in some of the major ports to decongest the ports. But now this is formed part of a law. So this is something that may need to be factored in terms of logistics while shipping goods to India. A procedural safeguard has been introduced by way of a deadline of 2 years for completing investigations. This was something that used to bother a lot of SSEs, where investigations will drag on for years. We don't know when whether a closure has been achieved, if anything is happening. So that way, this is a very welcome change that there is a deadline, and we know that, okay, after 2 years, it has to be over one way or the other. In terms of the legislative changes, the first one, of course, is there is an introduction of a sunset clause of 2 years for all conditional customs exemptions. Now, the idea behind this is to ensure that there are no anachronisms, there are no exemptions which have outlived its relevance, continuing on the statute books. So every 2 years, it will cease to be effective unless specifically extended. This gives us better control. The government gives the government a better control in retaining exemptions only which are absolutely necessary and relevant. Some of the changes on the legislative side have been to enhance enforcement and to plug any sort of frauds or fraudulent claims. So power has been given now for to confiscate goods which are sent for export under a wrongful claim of export-linked benefits. Similarly, when fraudulent claims of credit refund are being made under GST law on the basis of export of goods, a separate penalty under Customs Act is being envisaged, which will be up to the 5 times the value of the refund claim value. So there will be 2 levels of penalty, one under GST law itself and another under customs law, as long as the goods are being sent for export. In terms of exports being made from special economic zones or export-oriented units, clarity has emerged vis-a-vis clearances or imports of goods on which there is anti-dumping duty or countervailing duty or safeguard duty being levied. Whether import by a SEZ or EOU would also suffer that. There has been some bit of dichotomy, confusion about that. So that aspect has now been very clearly laid down, that it would be applicable, such duties would be applicable for imports by EOU or SEZ units if the notification imposing those duties are specifically included, specifically mentioned their applicability for imports by SEZ or EOUs, or if such goods after being imported by a SEZ is being cleared as such to a domestic tariff area within India, or being used in manufacture of a product, which final product is being sent cleared domestically in India. Now, this probably is an unintended distortion, because what happens is, if a SEZ manufacturing unit is importing a particular product or input material which is liable to anti-dumping duty, uses it for a final product which is then cleared into the domestic tariff area. On that clearance, there is a normal customs duty that would apply, plus there will be some element of this anti-dumping duty which will be loaded. That loading would not happen if an importer in a domestic tariff area were to import the same final product from outside India. This clearly is an unintended distortion, because there is a fair bit of idle capacity, manufacturing capacity in the special economic zones in India, and representations are being made. One hopes that this anomaly would be corrected. In terms of international trade regulations, again sticking with the theme of tightening enforcement for levies of countervailing duty or anti-dumping duty, if the exporting countries have reduced prices further to absorb the effect, or have come up with other ways of circumvention, the law is now being amended to take care of or to tackle those circumvention or absorption scenarios also. While thankfully no Corona cess was introduced, Agriculture, Infrastructure and Development cess, AIDC, has been introduced. But the good part is this does not lead to enhancement of the tax cost. So in whichever instance this particular cess is being imposed on import of goods, to the extent proportionately the customs duty leviable thereon is being reduced. So the net impact will remain the same. I think the purpose is, of course, if something was part of a customs revenue, the central government would have to share it as a part of its larger kitty with the state governments. This way, this particular fund would be earmarked for the specific purpose of rural and farming sectors improvement. And to that extent, they have a dedicated purpose. Next slide, please. Khaitan, can you have the next slide? Thanks. In terms of the rates movements, without getting into too much of a detail product-wise, the larger theme is, as the speakers before me have highlighted, the larger theme is to encourage and ensure that India emerges as a destination which is, which encourages value-added manufacturing. And to that extent, it's a very conscious choice, a conscious policy at work, where the rates are being rigid. In some cases, of course, the rates have been rigid to ensure that there is no inverted duty structure scenario. So products, some of the agricultural products, some chemicals, certain textile products, etc., have seen an upward movement, whereas specific instances of imports for aviation sector, in medical equipment, certain specific projects, infra projects, they have seen a downward movement of customs duty rates. Keeping in mind the commodity price volatility in the recent months, anti-dumping duty on certain products like rods of alloy steel, steel of non-cobalt grade, certain other flat roll products of steel, etc., they have been suspended till about September 30th this year to protect the Indian importers and users from a price shock because of the commodity volatility. Next slide, please. Coming to central sales tax, as I had mentioned, that this is a pre-GST tax which continues to apply on products like petrol, diesel, aviation turbine fuel, natural gas, etc. As a context, we need to remember that there is a 2% CST rate that is available for certain specified end users. If I am purchasing today, these products for usage in a telecommunication network, manufacturing, mining, etc., etc., I can buy them at a 2% CST rate only. The budget proposes to do away with many of those end users, namely for usage in telecommunication network, for usage in mining, generation of electricity, manufacture or processing of goods. So in all of these cases, instead of 2%, now the input side CST will be at a much higher rate depending on the rate or at which VAT is being charged on the same goods in the origin, state of origin. So for something like diesel, which is often used by telecom towers across the country for keeping the power supply, for maintaining a power supply, they will have to buy diesel at rates which will vary anything between 22% to 31%. So that can be a significant jump in the input side tax cost. And given the huge amount of focus and incentivization of the Make in India program, it's a bit counterintuitive, because this can sort of adversely affect and enhance tax cost for the manufacturing sector, even for the passive telecom infra sector. And representations are being filed for seeking a reconsideration of this particular movement. But if no reconsideration happens, one would need to look at change in law provisions under various contracts. One would need to renegotiate prices, because this is likely to be a significant enhancement of input tax cost. Moving on to GST proposals. Next slide, please. Thanks. In GST also, the theme of the budgetary proposals circles around enforcement, circles around trying to plug loopholes or tax optimization options that SSEs have come up with over the last few years. The first one, and this can be an important one from an infrastructure sector perspective, the scope of the word supply, which is the chargeable event under GST, has been expanded to include transactions of goods or service between an artificial person and its constituents. Namely, where can this apply? Not vis-a-vis a company and its shareholders, because company, that is not what is sought to be covered here, but unincorporated consortium and an unincorporated joint venture, association of person. In all of those scenarios, this may trigger. Earlier, so far, the law only covered association of person. The word association of person is defined and has a specific connotation under income tax laws, and that is what was borrowed under GST as well. Now there is a clear widening, and this is retrospective, so with effect from 1st July 2017. So any German company which has tendered or is planning to participate in a bid in an unincorporated consortium with an Indian company will need to factor this particular amendment and do an impact analysis while arriving at the bid price. The conditions for input tax credit availment has been further tightened. Now, this has been a recurring theme. The government has been plagued with, and there has been a lot of discussion about rampant GST input tax fraud that is happening, or that has been happening over the last 1.5 to 2 years. There is a spree of arrests, etc., that are happening to curb down, and it is this particular proposal has to be seen in light of that, in light of that context, that there is a massive amount of revenue leakage that is happening because of these frauds, and the government is trying very hard to keep up with them, to catch such fraudsters, and to that extent the power under the law is being enhanced. In the same theme, if we go to the next few bullets, commissioners, senior tax officers, they have been empowered to provisionally attach any property belonging to people who retain the benefit of any tax fraud or who cause such tax fraud. So it is not only the person who is probably undertaking the activity of a tax fraud. If someone has been advising him, if someone has been abetting that, if someone has helped that person, if someone is deriving benefit of someone else's tax fraud, all of those people can now come under the sweep of this particular power that the commissioner will have to provisionally attach property, and property can include bank accounts of such people. Similarly, recovery proceedings in cases of self-assessed tax, where I have declared a particular amount of tax but have not made the payment, the procedural safeguards are being removed, the screws are being tightened to ensure quicker, faster recovery in these kind of cases. Also, provisions pertaining to detention of goods in transit, seizure, confiscation, they are also being tightened, loopholes removed, penalties enhanced. So overall, as I said, the larger theme is enhancing enforcement, curbing fraud, curbing no tax positions which are sort of not envisaged under the law. Specifically on exports, also there have been a couple of important changes. Exports, as some of you may know, are what we call zero rated in India. So supplies to special economic zones or exports out of India attracts a zero GST rate, but the exporter can get input credit of taxes that have been used for making such exports. So far, exporters had the two options. One, to pay GST on the output side and claim refund of that particular output GST, or not pay GST on the output side and claim refund of the input side credits. Depending on various factors, exporters were choosing. People who were in a highly capex intensive business, or people who would have transitioned a lot of credit from the pre-GST regime, they were opting for the option of paying GST on the export and claiming refund of that. And these refunds thankfully were coming quite expeditiously, and to that extent was really helping the cash flow situation of the exporter community. Unfortunately, a lot of frauds were happening vis-a-vis these kind of exports also. Probably as a reaction to that, the government has decided to take away this particular option of paying GST on the output side on exports and seeking refund of that. There is a leeway kept where in some indeterminate future, government may notify certain categories where that option may be brought back. But as on date, the intention clearly is to do away with this. Also, there is now a requirement to ensure that if you have claimed refund by exporting goods, you must ensure that you have received payment for that in line with the foreign exchange laws of India. Else, that refund along with interest has to be taken back. And benefit of zero rated supplies. So as I said, supplies to a special economic zone is also zero rated like exports. But now it is restricted only if anything that you are supplying to a special economic zone is for what is known as authorized operations of that special economic zone. Authorized operation is a list of authorized functions or activities that the development commissioner of a SEZ grants to a particular unit. So there is an additional level of check for anyone making any supplies to a SEZ. They will need to check what is exactly is the authorized operation, maybe have a agreed upon documentation process, because otherwise the risk of taking the zero tax position is on the supplier to the SEZ and not on the SEZ unit, the recipient. So to that extent, contracts or processes under contracts may need a relook. So to sum up, the indirect tax proposals, A, are driven by Make in India, and B, to curb all sorts of tax frauds or input credit frauds. Powers have been enhanced significantly with the government authorities. One hopes that by the time these amendments come into force, government will have issued detailed SOPs or circulars to ensure that these things do not get misused by officers against genuine and honest taxpayers. With that, we can close the discussion on indirect tax proposals. Over to you, Ken.
Thank you, Sudipta. Thank you, Prasenjit. Thank you, Vinita. So, ladies and gentlemen, now we are open for Q&A session. So, if you have any questions, please click on raised hand icon and I can unmute you to take your question. Meanwhile, I have some questions already received. So, the first question is for Vinita. Is there any change in dividend tax for German investor for dividends received from Indian company? You're on mute, Vinita.
Sorry, Khaitan. Now am I audible?
Yes.
It's a very good question. So purely a German foreign direct investor, that is an FDI investor, there is no tax change. So under the domestic tax laws, if they receive dividends from their Indian entity, it would be taxed at the rate of 20% plus surcharge and cess. But if they are eligible to tax treaty benefit between India and Germany, then the rate will be reduced to 10%. The only change which the budget had proposed is for a portfolio or a foreign portfolio investor, if they are earning dividends, there was an ambiguity while they are eligible to claim a treaty rate of 10%, would the withholding rate will be 10 or 20, which the budget has clarified. So to nutshell, there is no clear change in the tax rates for a German foreign investor, for a strategic investor. It continues to be at the same rate as it was last year.
Okay, thanks Vinita for that answer. We have question coming in from Mr. Rajesh from Coastal. Hi Rajesh, I have just unmuted you. you can ask your question.
Good afternoon to everyone. This is related to GST. Whatever we filed in the after the budget, the government authority is not allowed for 8538 HSN code. They are directly the marked 8739. It will be applicable on 15% BCD directly, but our part previously in 7.5%. Again, GST percentage also previously in 18%. Now it will be applicable in the 28%. Even whatever we given information to the authority, along with the proof of the document as well as part details in the PH, they are not allowing for the previous HSN. They directly taken as per budgets 8739. It will huge impact on our business, purely in automobile.
No, but if your imports were before, or the transactions that happened before the budget, it should be governed by the laws in force at that time. I mean, at that time of export or import. Are they refusing to agree to that?
They are not allowed to some information also. Whatever we're trying to explain, that also not agreed for the government authority. They given only one word. They as per automobile, we have to file only for chapter 87. Previously, we having several HSN code like 8358 and 732. Some other HSN code also is there for 8536 somewhere. But they directly given instruction, you have to file only for 8739 or 8739 1000. It will most impact on the double time of the tax.
I understand, sir. I mean, I'll probably need to understand a little more detail as to what is being said or what is the rationale behind that. But all I can say is they are bound to give a reasoned order for any such rejection, or at least give you a hearing where we can explain as to why we believe this is the right classification. But maybe we can, because this is not specifically linked to the budget in that sense, we can take it offline. So my it up offline.
Yeah, noted. Thanks.
Thank you, Sudipta. Thank you, Rajesh, for a very good question. Now, next question is for Prasenjit. Are there any specific measures to boost growth of MSME sector or startups?
Yes, indeed. I mean, we briefly alluded to at the very outset. I think some of the changes which are very bespoke for MSME sector is the whole first of all, the capital outlay. There's a lot of excess capital outlay which has been earmarked for MSME sector. This will definitely help boost manufacturing activities. Secondly, all the PLI scheme, the production linked incentive scheme, this is directly linked to sectors like electronic, healthcare, textile. All of these are critical sectors, in MSME space. So a lot of encouragement is being, kind of rolled out by government, that if these MSMEs manufacture locally, then it obviously can benefit and get a lot of this tax incentives and other incentives on the manufacturing process. The third, I think, big step which government has announced for MSME is the debt resolution in a fast track manner. We all know that during the COVID time, all these MSMEs got embroiled into defaults, and MSME is really not in a position to get into a long drawn debt resolution process. What you need is a streamlined, well reformed, fast track debt resolution process. That's exactly what the government has alluded to, and that augurs very well for MSMEs. So these three steps I think are really, really kind of interesting and sets the MSME sector very nicely up for nice flourishing progress in this current financial year.
Thank you, Prasenjit, for the answer. I guess we are not having any further questions coming in from audience. So I would like to thank all speakers, including Prasenjit, Sudipta, and Vinita. Thank you very much for your time. Today, Mr. Vitil from Embassy of India for introducing us the MIIM, and audience for your patience and participating in our webinar today. we will definitely share the presentation along with the recording by tomorrow, let's say. And thank you very much again. Have a nice day ahead. Look forward to welcome you in next webinar.
Thank you, Khaitan. Thanks everyone.